Have you ever stared at a chart and thought, who's actually moving these prices, and how do I ride along with them instead of getting crushed? Today, we're going to uncover one of the biggest secrets in trading, supply and demand, also known as the smart money concept. By the end of this video, you'll know exactly where the big players are placing their orders, and how you can trade alongside them. So, what actually moves price in the Forex market? Well, it all boils down to one simple thing: supply and demand. Think of it like an auction. If there are more people desperate to buy than there are people willing to sell, the price gets bid up. If everyone is rushing to sell and there aren't enough buyers, the price will tank. It's that simple. But here's the catch. The people who are really moving the market aren't small retail traders like you and me. Honestly, we're just droplets in the ocean. The big waves, they're made by the heavy hitters, the banks, institutions, and market makers who place massive buy or sell orders. These are the orders that can smash through support, break resistance, or send price flying in one direction. When they step in, they create imbalances in the market, those strong, impulsive moves you see on the chart. Our job as retail traders: we're detectives. We look for the footprints they leave behind. We figure out where they place their orders, and then we try to ride along with them. In a moment, I'm going to show you 3 key supply and demand areas where you can actually spot these footprints, because once you see them, I promise the chart will never look the same to you again. The first important aspect is how price reacts to support and resistance levels. It takes a significant amount of transactions to change the price direction and form these levels. That reaction is one of the clearest footprints left behind by market makers, something we can study and use to our advantage. For example, in this chart, we can see the price forming a resistance level. Initially, the price moved upwards, but then it was pushed down from this point, indicating significant selling pressure. We mark this area as a supply and demand zone based on support and resistance. To mark it, we start from the end of the candlestick body and the tip of the candlestick wick. However, we shouldn't jump into trades just because the price touches a support or resistance level. It's smarter to wait for confirmation, like strong momentum candles, rejections, or clear candlestick patterns, before pulling the trigger. This extra step helps filter out false signals and improves your trade accuracy. Then, we can see the price rise from here, indicating significant buying pressure. This pushes the price up and breaks through the previous resistance level, turning it into a support area. The price then moves in and out, pushing back to a similar point, so we'll mark this area as a new resistance. Now, pay attention to what happens here. We see a rejection candle, which means demand is starting to enter the market and push the price up. Then, a green candlestick forms, creating a bullish engulfing pattern. The green candlestick indicates strong buying momentum, and the price will rise, breaking through this resistance level. Finally, this resistance now becomes support. Next, the price rapidly moves up and down from this area, indicating significant selling activity in this zone and pushing the price back to the support level. Now, observe carefully what happens in this area. A shrinking candle starts to form, indicating that sellers are weakening. Buyers start entering, and a green candle is formed, creating a bullish engulfing pattern. The strong green candle indicates that demand is now very strong, and the price subsequently rises to meet the supply zone again. Notice that the price reverses from there and starts pushing the price up, only to fall back to the support level. Now pay attention to what happens here. Buyers enter again, and the price continues to drop, resulting in a long-tailed candlestick in this area. This indicates a battle between buyers and sellers. From this point, more significant selling occurs, pushing the price down rapidly and breaking through several levels. This indicates a strong supply in this area, so we mark it as a supply zone. And in this demand area, the price forms a rejection candle and an engulfing pattern. Then, the price rises toward the supply zone. Here, the price forms a shrinking pattern, indicating weakening buying pressure, and sellers start entering. Finally, a bearish engulfing appears, indicating that sellers have won the battle and the price falls again, and so on. By paying attention to these details, how price reacts to levels and what the candles tell us, we can start to read the market's story and trade more effectively. Next, let's discuss supply and demand areas based on the concept of rally-base rally and drop-base drop. Perhaps you've already heard of these patterns. In a rally-base rally pattern, the price initially rises, then consolidates, and finally experiences a rapid ascent. On the other hand, in a drop-based drop pattern, the price falls, consolidates, and then drops rapidly again. For simplicity, I'm going to replace these terms with order block areas for this explanation. Key conditions for a valid order block. So, the conditions for a valid and high probability order block are as follows. First, there must be an imbalance after the base formation. Second, it should be accompanied by a break of structure or the formation of a new high or low. Now, let me explain this on the chart. To find these rally base, rally, or drop base, drop areas, you first need to identify the imbalance area on the chart. How do we recognize an imbalance? We can identify it by looking for candles with very strong movements. If you observe that the tail of the first candle does not touch the tail of the third candle, it indicates an imbalance. This means there's significant demand that overpowered the sellers, causing a price jump and forming an imbalance based on this candle. For example, here we can see the price moving up from this level. Then it consolidates sideways and forms a base, indicating that sellers are entering this area and halting the price. However, larger demand enters again, creating two imbalance areas simultaneously. This indicates a strong demand from this point. The strength of this demand pushes the price to break and surpass the previous structure, which is called a break of structure. So, let's summarize what we have here. First, the price shows an uptrend structure, indicated by higher highs and higher lows. Then, there's a break of structure that creates a new higher high. Additionally, we observe a rally base rally pattern followed by imbalance areas. Based on this, we can place a buy limit order in this area. We set the stop loss slightly below the demand area. For the take profit, we can place it at 75% of the previous highest point, or you can use a risk to reward ratio of 1 to 1.5 or 1 to 2. This trade ends with a profit. Here we can see the price experiencing another break of structure. In this area, we can observe two rally-based rally patterns followed by imbalance areas. Additionally, we can see the price bouncing off this area. For the drop-based drop pattern, it is the opposite. For example, here, the price forms a downtrend structure with lower highs and lower lows. We can see a break of structure in this area. Then, in this area, we can see the price forming a drop-based drop pattern, where sellers push the price down. Buyers enter and attempt to push the price back up. However, larger sellers enter, causing a significant movement and forming an imbalance area in this zone. Therefore, we will mark this green candle as the base candle. As a significant supply enters from this base area, we will enter a sell limit order in this drop-based drop area. For the stop loss, we will place it slightly above the base area. The take profit will be 75% of the distance from the lowest point before the price reverses. This trade also ends with a profit. Next, let's talk about order blocks, which is one of my favorite concepts. An order block is simply a candle that precedes an impulsive price move. For a demand area, if the price is moving up, the demand order block is the last bearish candle right before that increase. Similarly, for a supply area, if the price is moving down, the supply order block is the last bullish candle before the decline. The conditions for a candle to be considered a strong order block are: first, the order block must create an imbalance area. Second, the price must also create a break of structure. For example, in this chart, we can see an uptrend indicated by the EMA 200, so we will only look for bearish order block areas or demand areas. First, we need to identify the imbalance area. In this example, we can see an imbalance area accompanied by a break of structure. Before the imbalance, we can see the last bearish candle. This candle represents our demand order block. Because we are in an uptrend, we will only focus on identifying these demand order blocks. Then, we can see another demand order block where the price creates an imbalance and a break of structure. This is another order block area. Notice that the price bounces off this area, indicating demand at this order block. We can also observe an imbalance and a break of structure below this candle, followed by an order block candle. The same goes for this bearish candle. Notice that the price always attempts to reverse direction from this order block. Let me explain what actually happens in this area and why the price bounces from here. Below, buyers or demand enter with a significant amount of buying, causing the price to start moving up. However, at this point, sellers enter and try to push the price down, creating this bearish candle. Then, demand re-enters with a substantial volume, creating an imbalance area and a break of structure. So, When the price returns to this area, it will meet that previous demand that pushed the price up. Now, for the bearish order block, here the price is below the EMA 200, so we will only look for supply order blocks. I will directly mark the imbalance area, the break of structure, and the order block area. Notice that when the price returns to the order block area, it often gets rejected by supply and bounces off this area, indicating the presence of institutional supply. So that's the crash course on supply and demand, the footprints of the big players. Learn to spot these zones, combine them with solid risk management, and I promise you'll start seeing the market in a whole new way. If you enjoyed this breakdown, smash that like button and hit subscribe so you don't miss the next strategy session. Alright traders, I'll see you in the next one. And as always, trade smart, stay safe.